So we got to the point in which the relation between price and cost becomes fundamental to understand what the hell prices are or how they work. Let me stress again that what I'm trying to do in this part is trying to really go from simple, obvious thing, everyday observation, to the more complicated and theoretical. In doing so, as it will become clear in the second part of the class today, when we start talking about values and finally get to a bit of a historical perspective, what may seem to be obvious today was clearly not obvious only a couple of hundred years ago or even 100 years ago. In fact, thinking about the determinants of prices and the determinant of value is, I believe, an excellent way to understand in what sense social sciences in general, not just economics, in their effort to try to find universal laws, have to keep lowering their ambition, in the sense there are probably very few universal laws about human society. And even if there are, you have to have the ability to see them at work in very different historical contexts. Things that today seem obvious to us, like the thing I said about exchanges. I mean, nobody said, oh, that's absurd, that's debatable. I try to stick to the very common sense. Only with the Lindahl equilibrium, we're going a bit on more theoretical high ground, but the rest was pretty obvious. As you will see, we're not obvious at all in the world of the even 19th century or early 20th century, where people still debated and to look at prices in a very different way, at least the majority of people. Okay, so what we have done is to build up from what seemed obvious to get to the big theoretical problem, which is a big, maybe meaningless problem. As I try to make clear Tuesday at the end of the class, in this idea of the Lindahl equilibrium, which was developed by Lindahl in thinking about public goods, but it actually can be generalized, this idea of truth-telling, to pretty much everything. And it becomes strictly the problem of market socialism. It's the same thing. Lindahl, obviously, the original motivation was what we call public goods, which, by the way, are not really public goods, are goods financed through collective taxation, whatever. We'll see in a moment, just to make sure that everybody knows what the language means, what a public good technically is for an economist. So he was talking about a bridge. Bridges that connect two parts of cities, Buda and Pest, Oakland and San Francisco, San Francisco, Sausalito, things like that, are public good in the sense that they're typically financed by the public purse, local administration, and often everybody can use them. Sometimes they have prices, the fees, the tolls. If you've ever been in Manhattan, you will have learned that in order to get out of Manhattan, you got to pay. There's no way out of Manhattan. Well, you can walk. You can certainly take the Brooklyn Bridge and walk to Brooklyn. But if you want to get out by car, through the tunnels and so on, you have to pay. Many other bridges, you don't have to pay, right? If you pay, the public good is no longer a public good. You may get the wrong price. Some people may say, oh my God, what a long line. If the bridge costed twice as much, there would be a much shorter line. I'd be happier because I'm happy to pay twice as much and have a much shorter line. But that's a different story. Most bridges don't have a price. You just cross them. But obviously, they're not equally useful to everybody. Many people don't cross the bridge. Like Calatrava, right? I don't cross the Calatrava bridge. There was a colleague that reached me the other day after class and said, why do you talk bad about the Calatrava Bridge and tourism in Venice? I said, well, this is going to become an interesting topic late in class. We're going to talk, when we talk about economic growth, we will use Venice as a good example of economic implosion. and debate this myth that without tourism, Venice would be dead. But that's for later. So many people don't use the Calatrava Bridge. None of you do. You probably come by train, right? You use the, what's her name for the bridge that for the student that they name after the student, right? Or maybe you don't. If you live here, you come by Ponte delle Guglie, whatever. The point is that even if they're public good, they're not used equally by everybody. That's the point. Okay, otherwise I get too long. And so Lindahl said, and how do I decide if building a bridge is really worth it? And I say, oh, it's obvious, right? The colleague that day says, come on, it's obvious, right? You had all these people that arrived at the station and they had to go through the small Fondamenta and then cross this bridge and the other to get over to Canareggio, Stradanova. Now they come directly and there's no, it's much easier. So I said, why is that obvious? Why is that fact makes obvious that we should build a bridge? You see, the so-called public good are act of redistribution. There is essentially no economic action, very few economic action are good for everybody. Almost all economic action redistribute from one group to another, sometimes from very few to a lot, sure, but still. So building a bridge, any bridge, anywhere, will favor some and not others. And the cost of it will be distributed in a certain way. Why? Because whatever resources you use to build the bridge could be used for something else. Never forget that. When somebody tells you that this is absolutely good, the city needs it, the country needs it, happiness needs it, the patria needs it, well, bullshit. Somebody needs it, somebody don't. And so Lindahl had this problem and he said, but there is a solution to this problem. And the solution to this problem is that if everybody tells the truth. You see, it reached over for 2 can openers, everybody and truth. If everybody tells the truth, everybody will truly reveal their preferences for the bridge, their willingness to pay, how much it's worth it. And therefore, and whoever builds the bridge will also truly reveal how much it costs. And then all we have to do is to add up, right? I just add up. It's worth so much for you, so much for you, so much for her. It's actually negative value for him. He's telling the truth. The bridge damages his, I don't know, whatever, his sense of aesthetics, his walking habits. He has to bend when he goes up with Carolina, whatever, you know, lots of reasons. Then we add up the algebraic sum, and if the willingness to pay is larger or equal to the cost, we build the bridge. That's a fantastic solution. That for sure allocates resources efficiently. Do you agree? That's called a Lindahl equilibrium. Now, if you take this approach, which Lindahl developed to think about public good, I mean, it wasn't Scandinavian by chance. Huh? These guys have a very different approach. See, culture does matter a lot. And I say this with envy. True. Because Scandinavian countries sometimes are boring. There's not a lot of sun. And even if they've learned to cook in Stockholm, you can eat very well, Oslo as well. It's not as good as here and so on. A lot of other stuff. But man, they're good for a lot of other reasons. There's a lot to learn there. But anyhow, we had this idea. Let's invent a way so people tell the truth. If people tell the truth, then socialism, bang, communism, bang, utopia, bang, in a second. Paradise on earth. If people tell the truth. All you have to do is to tell the truth. See, mother used to say, Maria, don't lie. Dire le bugie è brutto. See, if you don't dite le bugie, about your personal preferences, we'll all live together. Problem is that it's not an equilibrium strategy, because if none of you lie, I will. I know, life is tough. But anyhow, that's the base of all this that you see here, right? What does that mean? It means that if we could induce people to tell the truth, then we could really compute the social cost and benefit of something, and that would be the true price. Notice that you don't need a notion of justice. You only need a notion of efficiency. I'm not going to make any claim in this class or ever about justice. I have no idea what social justice is. But if there is anything I will try to convince you is there is not an objective, shareable definition of social justice. I do have my view of social justice, but it's mine. And it's heavily biased by the fact that I am such and such, I was born in such and such place by such and such parents, and so on and so forth, and all the rest, the king, which I will not tell you because 65 long years are very long to tell. So I will not tell. So every debate about I do have the true theory of social justice is bullshit, which doesn't imply we don't have to debate about social justice. Debating about social justice instead of punching each other about social justice is a much better approach. We debate and then somebody wins. Somebody loses a lot, somebody loses a little. We'll find compromise and we change. But this is not a theory of social justice. It's a theory of efficiency. So when I say true price, I mean the price that reflects exactly the cost that people bear and the gains that people bear. In some sense, right? If you take Lindahl approach and you just use a little bit of algebra, that is, you take the cost and you bring it on the other side with a minus sign, then what you want is to build anything that has a positive price, meaning the willingness to pay is larger or equal to the cost, the true cost, right? And everything that instead has a negative value, you don't, because in that case, the social cost is higher than the social value. That's where, in some sense, the modern theory of prices have got. And obviously, one thing we have realized is that implementing in societies a true Lindahl equilibrium is a bit of a myth, which doesn't imply you don't have to try. And here you have to walk a very fine line. You have to want, you might have heard people talking about social engineering, right? There is if you take the myth of Lindahl equilibrium seriously, that is, you start dreaming that you can actually implement it. There is plentiful logical and empirical and even common sense reason that suggest, well, that's crazy, that's going to create a lot of disaster. Which does not imply that in specific instances, you might try, I mentioned the other day the word, to implement or to discover mechanisms that locally allow people, or not allow, give people the incentive to tell the truth. Okay? All the theory of auction, which is the theory of pricing, essentially, all the actual auction activity in the last 40 years, 50 years, is just an application of that idea. The whole theory of auction is based on the fact that an auction is a mechanism. And it's a mechanism that, because it's a rule, right? It's a set of rules that you have to follow to reveal how much you're willing to pay, how much you're willing to accept, and who, between those that are willing to pay and those that are willing to sell, gets what, and how you get exchange. You have an auction of a single object, a multiple object, a variety. Right? There's a large variety of auction. And they're all built on this idea of mechanism design. The idea of mechanism design is due to a man that was very nice, somebody called Leo Hurwitz. Leo Hurwitz was a colleague. I convinced him to retire. He was a professor in Minnesota. He was of Polish origin, obviously ran away from the usual ones you can imagine. And Leo was a kind of die-hard soft socialist in the sense that he liked to think that there was a way of thinking at Lindahl, and took Hayek and many other arguments of the debate about market socialism. The debate about market socialism is the debate about Lindahl. The debate about market socialism is there a way I can announce prices, me as a Ministro della Produzione, so that everybody just following those prices, do the right thing, and we got socialism? Answer is theoretically yes, but for the reason we just said, probably not. Okay. And Leo went after that, and he started thinking, how do we create social mechanisms so that non-violent, obviously, which willingly, just because of incentive, people tell the truth. Came up with something called the revelation principle, that is, you reveal your true preferences and so on. He ended up getting the prize, and the prize was very well deserved. And there is still a lot of work on that. And the output in terms of human life, of auction design, has been very useful. They're very practical use. And as allocational mechanisms, they're a lot better for procurement or for allocating radio waves than politicians giving it to their buddies. So auctions are a good thing to have, as opposed to the power to say, oh, you get it because you're my friend, okay? But they're a far cry from a Lindahl equilibrium. So if you're interested, that's where the theory of pricing has taken researchers in the last few decades. And in fact, it might have been the area of economics that got more recognition in the last few decades, both in practical terms. Some of the colleagues expert in auction design have become very rich by consulting and selling the way to do auction. And so they got a lot of prizes from Milgram to Wilson to and so on. Okay. The second summary line there says prices and social justice. Why? Because, as you know, there is an eternal debate, and it's still going on. And I would like to hear about this also in class.
Sorry, Professor.
Some prices are just and some prices are not. That by modifying prices, we achieve social justice. Okay, that it's a way of achieving social justice. As you know, many instances, even in modern societies, in the past, it was extremely frequent. Governments sometimes fix prices. So prices to be such and such. You cannot go above that. You cannot go below that, right? I think it's worth debating
Professor,
when that's the case or not. Which also lead to the big question. Somebody even wrote a funny book recently on the topic. Can we give a price to that?
hello, Professor.
You see, the answer to that is, well, I don't know if I want everything to be tradable, but for sure I can compute the cost of everything. And therefore its price. Or if I cannot compute because it's too complicated and the information amount, the type of information that I have to obtain in order to compute it, falls in the myth of Lindahl equilibrium, that is, people have to tell me the truth, and they are unable to. Still, I can understand that there is a price, even if it is not computed. Obviously, that's the case for public goods. Public goods have a price, that is, they have a cost. By the way, it's become a very frequent misuse, so we will do it too. We call public goods now everything that is provided by some state agency. Technically, a public good as opposed to a private good in economics is not anything provided by a state agency. So the emergency room in the public hospital is not a public good. Why? Anybody can help me with that? You remember? I'm sure somebody taught you in class. Why is that the emergency room at some public hospital is not a public good? If people that are online wants to tell me something, you have to open up the microphone and speak, because I see you're writing on the chat, but if I start reading the chat, I get lost. So I think you can unplug yourself and just speak. I will probably hear you, or I hope I hear you.
Can you hear me?
I think that some people say you can exclude. Please. Because it's both excludable and rivalrous. There is a finite amount of space in the emergency room, a finite number of doctors, and a finite number of nurses, and a finite number of tools. And therefore, if I use she can, a public good, to be such that my consumption of the public good will not diminish the supply of that good for you and everybody else. So there are very few public goods, which is why a lot of talk about public goods is a bit of BS, good for political rhetoric, but not truly true. At any level, even the justice system is not a public good. If you sue me, you're taking somebody else's time. The judges, the district attorney, known in Italy as pubblico ministero, and so on. And therefore, if they pay attention to your case, they don't pay attention to another case. There are very few public goods. Air probably is a public good, which is why the CO2 problem is truly a collective world problem of externalities, because it's a true public good. Most other are not truly public good. If you want, they're collective good, or they're publicly provided good, and so on, or no market good, better. But whenever we look at one of them, we'll have to try to keep that in mind, okay? But they certainly have a price. In fact, we price them. We price also the emergency room in various forms. One thing that you understand by using a bit of economic analysis, this kind of insight, for example, on the opportunity cost and the things we brought up in the last 2 weeks, is that even in circumstances where the market is absent in its formal setting, and in which people do not explicitly bargain and do not explicitly price their action, there is a sense in which you can look at the interaction as one based on prices. Let me be a bit provocative. Think of the relation between male and female in a couple, or male and male, or female and female, between two people in a couple. Sure, in the Baci Perugina and San Valentino night, it's all about love, this mysterious thing. But in the real life, the one when you don't give the Baci Perugina and you don't take him or out at dinner on the night of San Valentino, it's about exchanging pleasantries, hopefully, but also costs sometimes. And for cynic that it may sound, and I hope I don't destroy any happy relationship in this class, it's clear that even in the moment of passions, people calculate cost and benefits of what they're doing. You may not like it. I know it's one of the reasons why they think that we are hurtless. But that's the way it is. We can go into the details, but I won't. I'm sure you can do it by yourself, right? Why is that? Is that very deep an observation? Well, in part. It's an observation that suggests that imperfectly, irrationally, talking about sentimental relationships, there's obviously something that we call irrational, which simply means taste. Some of us find it so rewarding to go out with somebody taller than us that we're willing to put up with the fact that sometimes he farts when he shouldn't, right? Well, they do. Even the most lovely one do it, okay? Or doesn't shave that often, or eats a bit too much, or never clean the damn coffee cup, and so on and so forth. Now, is that rational? Are there market prices? Well, they are internal things, as you will see. That's not so strange. It's not so different from the reason why I bought this watch as opposed to another one. Nothing rational in liking this piece of steel. There's nothing rational in putting it up with the fact that she talks a lot even when she's supposed to shut up, right? Because that's a cost of having her company on another dimension. And the other dimension, I like it so much that it compensates for that talking when I would like to be quiet, and vice versa. And she's probably putting up with you that want to be quiet when she actually feels it's time to talk, and so on. All right, enough. Point is that it's kind of hard to not price things, which implies, are moral values priceable? Obviously they are. Obviously they are. Even those that appear to be so priceless that you're willing to die for them, because that's exactly the price. Oh yes, evidently that has to be the price. If you're willing to pay it. Galileo had a lot of moral values. Certainly, his life was worth to him more than stick it to the Pope. Okay? So he said, okay, fine. You want me to lie? I'll lie. I beg. Sure. Because I don't want to die. It was a very, I don't know if it was rational or not. Obviously, it was waging the two things. Bruno apparently did not have the same price system as Galileo. He got screwed. And so on. You can go on. Now you say, my God, this Boldrini is really cynic and so on. No, I'm not cynic. I'm just saying that the logic of thinking and human action as a form of either explicit or implicit, either conscious or semi-conscious and even unconscious calculation on cost and benefit, while it does not explain everything of human life, obviously, it has explained a few things. And if you're interested, it's a huge literature that goes outside the kingdom of official economics, but it's very connected to what we do and what economists have been thinking. It's called with various names. The most popular is Evolutionary Psychology, okay, which investigates the evolutionary roots of this attitude. There is on the fact that humans, and not only humans, animals and living beings, have selected routines. Either most routines are not, we're not aware of them, but we use them. They tend to do this cost-benefit analysis in very many instances of choice. Even of choice that we make automatically. That is to say that we're not apparently conscious that we make the choice, or at least, I mean, we are aware that we have made the choice, but we are not conscious that we went through a process of deciding to make the choice. Okay? So if you're curious about this, about the price of everything, I recommend that you read not the popular political books on the topic, but instead go read the serious scientists on the topic that have been asking, the same question about elephants. Quite fascinating, in fact, the social mechanism of elephants, and about the evolving notion of morality and price and value and adaptation among humans. Not that we have understood everything, huh? Don't ever fall for the trap of the person that says, oh, I have the theory, that theory is perfect. But one after the other, little pieces come into the puzzle, and they make a lot more sense than before. Okay? So, price theory has got us to evolutionary psychology, and that's it. Moral. Every cost leads to a price, either explicit or implicit, as we just said. And every price signals the existence of some cost. So here's the very crucial notion if you want the modern notion of what a price mechanism, whatever it is, does. It contains information. So there is not something that can be priced independently from something else. Pricing is always relevant. You cannot take anything in your hand and say, the true price of this is such and such. As you will see in a moment, this is an extremely modern attitude of the problem. Because for centuries and millennia, people instead looked for the true price, independent from the other prices. Prices can only be understood within a general equilibrium system. The title of the slide is a bit of a joke on a famous book that some believe to be a Bible and I think to be a silly exercise, titled Production of Commodities by Means of Commodities. The book is not wrong. It's just a very simple exercise that people have confused for a Bible and the revelation of a truth. In case somebody knows what I mean, it's a book published in 1960 that is still hotly debated in some countries, including Italy. And so that's the reference there. The reference is that if you want to understand prices, you need to think about in terms of general equilibrium. That is, you need to think about the system of pricing altogether. And people should notice that today, in these days. I'm sure you read the newspapers, and there are all these talks about inflation, right? And some prices went through the roof and some prices didn't. And how do you understand that? You cannot understand that by simply looking at the single market or asking, oh, the cost of this and that has gone up. Because there is no way you will find the answer. The extremely complicated mechanism that worldwide has disrupted transportation, production lines, has increased the demand of some goods and decreased the demand of other, has shifted traveling practices and so on and so forth, has created this incredible variation in price. Incredible in the sense that they're much bigger than those that have been used for the last 20, 30 years. So people your age never saw price variation this big. People my age saw them because something extremely simple. This is going to be a brief memo for you for current economic policy. Something extremely similar to this happened in the 70s. So in the 70s, there were some major worldwide disruption. At that time, the world of economics was, the world of market economy was a lot smaller than it's now. China was out of the picture. USSR was out of the picture. Most of Africa was out of the picture. India was kind of out of the picture, and so on. So the market economy was Western Europe, Northern America. Mexico was kind of out of the picture. Japan and a few others. I don't think we were, not even 1 billion people, probably less. But the so-called oil shocks and then the change in the, earlier on, the change of the parity of the US dollar to the gold and so on, were huge disruption of the supply side and of the relative prices. And this created huge tensions, which revealed themselves at the beginning through changes in price. Why? Because to the extent that there is even a remotely free market mechanism, scarcity, either induced because supply drops or induced because demand goes up, is reflected in price. Economic policy misunderstood those at the time. Dramatic change in relative prices, and made a bunch of mistakes that during the 70s, early 80s produced what's known as stagflation. It's a long period, year after year, of very high general inflation and very little growth because of the continuous disruption. Hopefully we'll not make the same mistake, even if I think there are some tendency, but this goes beyond the scope of the course. But again, my point is, if you want to try to understand this change in price that we are observing in the last, say, 6 months, 8 months, you need to go deep and literally go through what people call the chain of the value chain. Closing and opening of ports, for example, closing and opening of some factories because there is or there is not a COVID emergency has dramatic impacts on prices. Has dramatic impact on prices. Suddenly I have a production process going on and there is a disruption in the supply of one key input. I'm willing to pay a lot for that input to take it away from another in order not to stop the production process. If you look at what happened with chips, that's exactly what happened, right? But it's happening with oil, it's happening with gas, it's happening with a lot of things. And there is no way you can understand those price changes by appealing to some true value, because the interconnections are very big. It's all relative. So I hope this may help you in understanding what happens in the world out there. Now, the historical part. Also because today would have to be in our schedule the first class on value. So price and value obviously are connected. So I talked about price in the contemporary modern sense before, started out from that last week and continued on. And value was more the way in which people looked at the thing we call price in the history of economic thought or social thought. Okay? So the contemporary view, as I write there, is that price contains some information about relative scarcity. And therefore they help allocating resources, not because they do something just or not. So you see, there's nothing just in the fact that producers of cell phones and PC managed to pay a little bit more on the market than producer of cars a few months ago when the market for chips got particularly tight and snatched a lot of the chip supply, therefore slowing the production of cars. Is that just, unjust? It's what it is. It's neither just nor unjust. It's just what it is. It means these guys had a bigger margin. They said, well, I'm going to lose something on the margin, or I may increase my final price to the consumer more than you do. And so I'll pay a little bit more and I get the component and you will have to wait, which is neither just nor unjust. It's just like rain. Okay? But it helps allocate a resource. It's signal a relative scarcity. Relative scarcity is important. There's no absolute scarcity. Nothing is always scarce or always abundant. It's all relative. It's all relative at particular circumstances. But again, for those of you that have some familiarity with economic theory, in a sophisticated theoretical model, we never talk about one commodity or an aggregate of commodity or commodities in general. We always say specific commodity at a certain point in space, at a certain time, and in a certain state of the world. Because water for me right now, for example, would be a lot more valuable, is a lot more valuable than water for me in 2 hours. In 2 hours, I'll probably be home, actually in 2 hours. Yeah, on my way to a restaurant. And so I probably went through home and picked up some water. Right now, I forgot to buy a bottle of water and I'm thirsty. So if somebody asked me, would you pay $5 for a bottle of water right now? Yes, I would. In a couple of hours, I wouldn't. And it's the same bottle of water and it's the same Michele Bulgari. Okay? So that's what relative scarcity means. Okay? And it's important to understand that the information contained has nothing to do with completeness. Another gigantic field of literature, which I'm sure you heard of, which has to do with stock market and financial market. I'm sure you've heard about the theory of financial market are perfect, are efficient, right? It's all about prices as well. You see how big the topic of prices is. I could have gone the whole 2 months talking only about price. Okay. Now, in the true theory of efficient financial markets, nobody, not even Gene Farmer, think the markets always have it right. The statement is much, much, much more humble. And yes, maybe the choice of word was silly. He should not have called them efficient, even if reasonably, I don't know what the hell he should have called it. But he should have thought when he was writing a paper only for Scholar that this would have ended up in the press and they would have made a fuss out of that word efficient. Efficient simply means that certain kind of market, trading market for financial assets, the competitive ones, tend to process available information efficiently. Now, every single word here is relevant, available information. So if now she pulls a bottle of San Benedetto from her bag and says, well, here you go, $5, okay? And I pay, that's based on my information. And if 1 minute after she sold that to me, somebody walks inside this room, some friend of mine, Helios Herrera, for example, who's here visiting, by the way, distinguished scholar and Venetian and former student, and says, Michele, Helios speaks Venetian, ti vuole acqua, ciapa. I would regret paying $5 for that bottle, right? Ciapa for the non-English speakers means, for non-Venetian speaker means, take it, okay? You see? Well, I traded with her $5 based on my available information at the time. And the available information was that I'm damn thirsty, and my saliva is getting thick, and I see no water. And nobody's saying, I'm gonna go get a bottle of water for you, old man. Okay? How did I know that Elias would have been listening and through Zoom and come in with a bottle of water? He's not, son of a gun. Okay? So that's what efficient marketing is. Now, obviously, people that trade financial assets will do all they can to figure out where the hell the world is going. And they will all fail in the famous joke. Prediction is very difficult, especially about the future. Nevertheless, that's their job, and that's what we all do, no? You do that too. You're wasting your time here at San Giove, not only taking my class, because you predicted something about the future. You hope that by the day you're done, people need people with your characteristics, and they'll be willing to pay some good salary for that. Or maybe that what you have learned will help you set up your business, whatever you want to do in life. Or maybe at least you hope that if you're doing it for fun because you are independently rich, the stuff you're listening to in class will entertain you. So you just use your information. That's all it says. Now, obviously, this can be made more precise. I'm making this a bit of a joke because this is not supposed to be a mathematical class. This is supposed to be. And so we have tried, also myself, but other more than me, to give a precise meaning to the word efficient and available information. And we have also shown, obviously, there are cases in which markets are not efficient. In particular, there is a famous paradox. Let me mention that because it's a paradox that makes you think about, which has a lot to do with some of the debate. It's a paradox due to Joe Stiglitz that everybody knows because he got the Nobel Prize and then he went banana. It happens. The Nobel Prize has strange effects on people. They should stop giving it. In fact, I've been recommending it for 20 years. Stop giving the prize. Okay. Hope it doesn't do bad to the dear colleague. They got the prize in physics. What's his name? Giorgio Parisi. Thank you. And he doesn't become a guru as well. He's a very nice person. Joe Stiglitz was very famous, and Sandy Grossman, who's not very famous, but he's a no less distinguished and brilliant economist, many years ago wrote a paper in which they said, well, there is a bit of a paradox. It's known as the Grossman-Stiglitz paradox. And it says, look, we're using the models we use are models of this type. We're trading some asset, a share, a bond, an option, an apple, a bottle of water, a car, whatever you want, a house, okay? Or many of them, there might be hundreds of them that we're trading. And she knows something about the price tomorrow, the value tomorrow of that asset, but she knows this something with a noise. He also knows something, and he knows something, and he, and each one of us has found out something which is partly correct and partly wrong, okay? And so to the extent that we are all in this situation, there is very many of us, And to the extent there is reason to believe we collect our information independently from each other, then there are reason to believe that the more there are of us and the more we transmit our information to the price, the erroneous part washes out. It's a fairly complicated application of the law large number, basically, okay? Or the convergence, right? Wide noise that washes out, okay? Correct. So start from there, take a word like that, and then put a little cost of collecting information. Because the original models that treated, they studied that problem, assumed that he had his information, because we received the signal, but didn't pay for that. It's like, you know, we woke up in the morning and almost without cost, other than as a byproduct of listening to the radio, shaving nails or, you know, doing a shampoo, females, we learned something about the stock market, okay? But assume instead, which is the case in reality, you actually have to spend resources to get information. Nothing is for free, right? That was obvious, and everybody said, yeah, Sandy and Joe are right. Well, they said, well, assume then n-1 of you are collecting information and trading using the information you collected. Why should I? I'm just one in a fantasticillion of people. The prices already contain all relevant information, given that you collected it. Why should I study the problem? I just look at the price. The price contains information. In fact, it contains the full information because it even eliminates the individual distortions. But the argument that applies to me applies to you, to him, and so on. And then the equilibrium in that game is that nobody collects information, so prices don't contain information. So the very same theory that says price reveal information truthfully also says, well, people do not have incentive to collect information. Now, and again, I will not continue, but if you're interested in understanding financial market, this is a very good starting point. It's old stuff. It's 40-year-old. It made lots of progress since. Let's start from there. Why? Because it explains why there are people being paid a fortune to collect information about assets. A fortune. It explains why studying mathematics and partial differential equation and stochastic processes and statistics may actually give you a very good life, for funny that it sounds. I wanted to read you a piece by Valore. You remember I mentioned the other day to you this article? So I actually, you know, I had read the paper long ago. And so I said, maybe I said something wrong in class. Let me go see if I have a copy of the paper and make sure that I quoted it right. So I went and found an old book, very old, which has the key part of the paper in that. And it's a bit long and it's in Italian. Everybody understand Italian here? Because I think we lost some of the foreign speakers. They're all gone. You don't. All right. Well, I will try to translate. So read the paper. It's translated also in it's 1908. Okay. So this is very old, long ago. And he says toward the end, some economists insist stubbornly, and I don't understand why, to remain deprived of that capital, intellectually very productive, when used jointly with others, which is given by a good understanding of mathematical and statistical notion. Those colleagues keep asking why we should learn mathematics to study economic policy. And he says, as my paper shows, I'm translating freely, but that's the meaning, mathematics and statistics serve us because they allow us to state those enormously complex problems. The paper is dedicated to study, as he said at the beginning, you know, Marx may be wrong, he says. I don't care. Socialists may be wrong in the sense that they made illogical statement, which might be true, but I don't care. Nevertheless, assume we have socialism. How should it work? That's another good example of a very bright mind. He says, yeah, fine. But let me ask, there is still a scientific problem, right? If we have it. What do we do? You see, use the can opener. He said, assume there is socialism. Then what do we do? What's a smart thing to do? Okay. And he said, that allows me to put an extremely complex problem, that is how to manage a socialist economy. Nobody had asked the question before, in a very precise way. It forced me, it forced my spirit, even, well, this is 1908, the user, to define the concept that I was trying to use, to not change the meaning of the concept and the words in the middle of the argument. How many times do they do that on TV? How many times do the bullshitters do that? Right? It forced me to not forget or change on the way of the argument the assumption I had made. Do you think that's little? Isn't it that the major part of sophism has origin in such kind of tricks? Try, without the help of mathematics, to reach the conclusion I've reached and to explain and show them with equal precision and shortness. It's a short paper, it's about 40 pages. Okay? And try to do it in the way, without using the mathematics that I've used in the previous pages, and so on. So I thought it was very nice. I said, Barone, 1908, he had it clear. Better tell the student class. Okay? So go read Barone. If it's translated also in English if you don't understand Italian. If you understand Italian, read it in Italian. It's an old style Italian, but it's kind of entertaining. Okay, and it's so for those of you, probably your library has it. Jesus, how old is this book? Do you know what the price of this book is? 3,000 lire. It's a bit good. I'm really old, huh? Oh. This was printed in April 71. God, I'm so old. Okay. Look at it. Anyhow, read Barone, okay? It's a good way of trying to understand what actually prices are. So keep that in mind. So when people will come and tell you, oh, financial market are irrational, financial market are stupid, financial market are disaster, financial market are this, financial market are that, they're not perfect because they make mistake, just say, okay, dumb. Obviously they make mistake. It applies to financial market what Barone says about people that want to do economics without mathematics, who want to do arguments without some formal discipline. Can you do better? All you have to do is do better. And to the extent that there are millions of people around the world that spends millions of hours trying to understand the way this or the other price, that or the other price works, maybe they're not perfect. Obviously, they're not perfect, but they're useful. And what they do is what is said. But this is a very novel point of view, very novel. Back then, they didn't say it that way. If some of you have downloaded the slides, these slides are old, I have prepared them already from last week. Change it because it would have been too long. So I said, well, I went back and I looked, I said, no, Aristotle. So I cannot pronounce Aristotle in English, sorry. It's one of those words I learned when I was 13, and Aristotle doesn't come out from my mouth, so it's gonna be Aristotle with good piece of English. It's Aristotle also when I teach in the United States. In some sense, economics until Galliani, or even later, or probably even Turgot, it's all in Aristotle. It's a bit because he said one thing and also the opposite, but mostly because maybe because of the cultural influence. And it's very interesting, actually. Let me try to give you some hypothesis of why that's so. He defined the term of the question. And the other that went after basically kept debating the terms of the question as he had put them, made some variation. Obviously, when Christian religion came, they took the Aristotle points of view and argument and twisted and turned them a bit and adapted to the extent they could be adapted. In the Islamic world, they had a much less friendly relationship, but they did. But at the end, he defined the terms and things. Plato had very little to say. Plato's talk about society, as you know, was mostly about this strange republic, which was essentially a command economy. And Plato had one contribution. I will talk to that. There is, I think in a couple of weeks, we'll talk about money. And this is something I learned from Schumpeter. I had not realized it by myself. Schumpeter made it clear, and I think he's right. Plato was the first chartalist. Make a note that it was the first one that said money is just a symbol. There's no intrinsic value to money. The value to money is what we decide it is, and it has to do with the reputation of the issuer and the authority of the issuer. We'll discuss that. Just make a note. Okay. And Aristotle instead was what you would call a metalist, or somebody that believed in intrinsic value of money. Obviously, at the time, facts were more on the side of Aristotle than on the side of Plato. Why? Because money was essentially metallic money, and it was heavily dependent on the cost of extracting the metal. Okay, and it was hard to notice that there was de facto deviation between the pure value of the metal and the value of the coin, and that value, the deviation, depended on the authority stamped on the coin. It became a lot clearer in Roman times and progressively, but it took people a very long time to figure out that that was the case, that there was nothing particular in the intrinsic value of the money. So that's a very interesting example of in what sense social theory, economic theory is also historical. If you think the fact that coins, money, was this, well, before that it was actually even other objects, but in most of the recorded time were essentially coins, okay, made of this or the other materials. Not necessarily of precious metal, often bronze, often sometimes stones and so on, particular stones, but it was in some material. There are also some other uses. And as the attention on money started focusing on gold and silver and bronze, people started to perceive that the value of money had to do with the fact that it was made of something valuable. And again, one could debate, why is that? People like gold. I understand why you like a banana. I understand why you like a steak or a nice beer or a double or glass of champagne. Why necessarily you like gold? Huh? That's nice, no? It's one of these fascinating problems. Well, it teaches you that value is a very relative thing, very relative. There's no absolute value. Anyhow, because that, it was natural that for a long time, people noticed that or thought that the value of money came from the fact that it was represented by a piece of, say, gold. And that therefore the oscillation in the value of money were induced by the oscillation in the value of the metal. Also because at a certain point, this was also partly true. That is, the amount of metal that was supplied, if the authorities, the kings or whatever, decide to turn into money, reduce the value of the currency and vice versa, okay? And so the historical fact created their own theory. For a long time, we took the theory as universal. And so we thought that money was gold and gold was money. And people theorized enormously about that, as Aristotle did. Now, when you look at that, now that history has changed, that other facts have happened, that other data have accumulated, as you will see, we'll have a different view of what it is, which does explain also the previous observation, but explains also the most recent one, whereas the Aristotle view would not explain why you're holding euros in your pocket that are made of paper, and even less why somebody accepts your credit card. Aristotle cannot explain why you bought your dinner with credit card, okay? but we'll go on. So anyhow, Plato was ahead. By pure chance, Plato had this intuition that there was a symbolic aspect to money, and that was what money. Aristotle stood on the other side. But for the thing we are concerned, that is value, Aristotle defined the debate for essentially 2000. And now I've put things in random order there. The two texts, if you're curious, that you want to look at are the Ethica Nicomachean Ethics and the Politics, in which he talks about this stuff. He doesn't talk a lot, so there's very little to it. His basic thing is very interesting, because the basic question he asked is essentially a very contemporary question. It's the same question we started our classes. If somebody exchange things, they must perceive that what they exchange is equal. Now, notice two things. One, for the theorists of market and capitalism and price are a very recent, was invented the other day by the Americans. Now, Aristotle seemed to have very clear what exchanging in the market was. Very, very clear. Okay, so they were certainly taking place at the time. Maybe not with the same abundance, frequency, and the number of commodities were very few, but he certainly had it very clear the way it was. But the interesting thing is that he starts from that observation. If you and I trade something, it must be an exchange of equals. And he also points out the other thing, well, but it might be that I believe that what you give me is more valuable than what I give you, and vice versa. And to the extent that that's true, or at least for one of us, then it's larger or equal, but the two larger or equal are different. She thinks that what she gets from me is worth more than what she gives me, and I think the opposite. Well, that immediately suggests to Aristotle himself, and here I didn't have time, so if some of you are good, you should, I didn't investigate literally the philological aspect. I had some notes that said the word he uses that is often translated with use value of an object in Greek, I forgot the word, is also translated as need, and is also translated as demand. The point is that he says, what it's worth for me depends on my need. I prefer to think it that way. The argument it develops makes much more sense if I use the current meaning of the word need, bisogno. I need something, okay? So it might be that for me, what she gives me is more valuable, slightly more valuable, that's enough, than what I give her, because I need her thing more than I need my thing, and vice versa. She has an apple and I want the apple desperately, actually. She has a mineral water and I have an apple and I need the mineral water desperately. Okay? What does it mean? It means that this look for the equivalence of need, Aristotle suggests, is in fact leading us to recognize that what defines the equivalence is the local temporary need of the two traders. And on this is very explicit. It says there are markets because there are needs. And there would not be markets with people trading if there were no mutually compatible needs, reciprocal needs. Okay? And he describes it as a barter economy, even if then he makes it clear that he doesn't have in mind a barter economy. He's talking about a market where we exchange goods for money and not goods for goods. Okay? But he's smart enough to notice that it doesn't really make a big of a difference, because the money being exchanged is a means of payment, but you are actually, in need of something. So you sell something to get the money and then to get what you need. All right. So that's now there's a big debate, because he's the one, and I should say that it doesn't convince me, but there is a current literature that tends to build a big metaphysics on the difference between use value and exchange value. The two notions are introduced first by Aristotle, at least that I know. He says, well, things have a use. And then they're also exchanged. So they have an exchange value. So they're valuable for us for what we do with them. And they also are valuable because we can trade them with other things. But it seems to me, and this is something I invite you to go check yourself, that this argument is the one I put there. There is the arrow, you see. It's what something does for me, its use value, that determines its exchange value to me. So I accept your bottle of water because I need it. And the use I will make of the bottle of water, or I intend to make of the bottle of water, and the use I would have made of my apple are such that I value your bottle more than my apple. That's why I trade, and vice versa. But it's also true that he insists on the fact that the exchange has to be just, the notion of what's called commutative justice, that is, the trade is fair. You give me something that is of equal value to mine. You can find it recurring in his writings, and he comes back continuously after that. And in my, it's reasonable to think I'm not really an expert. The problem fascinates me to a point. So now that I've spent my life studying this, it seems reasonable to assert that the search for the true value and the just trade starts more or less with him and with the debate in that period that continues on for 2000 years. Now, I'm also I'm tempted to say that if it was not this guy called Aristotle, whoever he was, that said that, somebody else called Beppe Bouleguin would have said the same thing. Beppe Bouleguin is just a silly name in Venetian, don't worry. Or Mario Rossi or Jim Smith. Why? Because if I think of the society they lived in and the amount of trade that was going on, the idea and the way they fought at the war, and this is my next slide, I think. No, let me jump it. No, where is it? Where is it? Oh, yeah, let me jump on it. Then I go back. The way they used to think most object or most activity they noticed as happening in nature, and he looked very much at trade as something happening in nature, was that in order to understand the meaning of things, you have to get their essence. Things have their own essence that defines them. What are they made of? What's the essence of things? And it's in understanding the essence of the objects that you have in front of, the activity you have in front of, that you understand the truth about them. And in the moment in which you understand the truth, then you understand the purpose of the thing. And in understanding the purpose of the thing, and when it comes to human action, you understand when human action is just or unjust. And so there is this line that you can clearly see in the old philosophers. The Romans become very cynical. They tend to ignore. There's very little contribution of Roman thinking to the kind of issues we are debating about price and value. But then he comes back in the scholastic literature, and he keeps going around in trying to find something that is the essence of trade, that gives the truth about the objects that are being traded, and that makes the trade, hence the prices, just. And it's all in the old Greek guy, all in the old Greek guy. That's certainly the view that was started there and continued. You find it here. I will not go deeply into this. You find in all these guys. I just mentioned some of the most relevant. It's very interesting. They do understand markets. So there's this whole literature about markets being a recent discovery that have dehumanized and mercification and so on. Whenever I read even St. Thomas or Duns Scotus, etc., I find it a lot of bullshit. I wonder what these people are reading. These people talk about markets. They talk about trade. Actually, they talk about demand and supply, and then they have a notion of fair price, and they have, interestingly, an implicit notion of competition. There's a note there. I should have said it also with Aristotle and the Greeks. They hate monopolies. It's very interesting. They always get very mad about monopoly. But they do understand the notion of monopoly. They do understand, they don't have the demand function, the elasticity, all that apparatus we have built to kind of formalize the argument, but intuitively, they don't like the monopoly. They do understand that if you're the only one selling or buying something, you'll screw the other guy. It will, in fact, they make it literally, it's different from us, they make it into terms of justice. The monopoly set up an unfair price. The price set up by the monopoly is unjust. Partly because they understood in those days that if you have the monopoly of something in a very simple technology like that, where state intervention in trade was there, but was relative, you know, essentially it was about allowing, either allowing or not allowing some people to come to town and trade, okay? And a little bit else, but not much more. Then obviously, if you were the only one selling something in a city, probably was because you found some violent or corrupt means to exclude others. Okay? But it's quite clear from Aristotle all the way on until the 16th century that the attitude of, these are all philosophers, moral philosophers, about monopoly is very negative. And they understand that they cheat on prices, that they increase the prices, that they get rents, and all these notions are here. They're not formalized, they're not even remotely mathematical, not even diagram, but the concepts are. The concept. And they do understand that the game of demand and supply, which they discuss, Molina and Dan Scottus in particular, but also St. Thomas, it's very clear. In fact, St. Thomas is very interesting. He's essentially a big theorist of private property. From that point of view, the people that need some rhetoric about private property can go and cite him. He's very precise about private property is essential. Without private property, people will not make efforts. Private property provides the incentive to do things right. If you take that away and expropriate, then people will not do things right. They will not invest. They will not work hard. So he's very much into that. And obviously, well, I put the word interest there just to remind me to tell you, but you know already, that's also a price that all across usually no good. And you still, well, let me repeat, I already said in one of the first lessons, I think the first, but let me repeat this story about usury because it's connected to the idea of what's just, of thinking at prices as just, and of thinking at just or not just in terms of essence. Because the whole story, it's almost hilarious. It's almost hilarious that these people do not notice that if I give you the money because you're trading with the Turks, or before with Byzantium, it's 1100, okay? And you're setting up the boats to go down the coast, right? Get to Constantinople and trade stuff. The money I lend you, it's because you gotta buy stuff here that you bring there and you hope to sell there at a higher value because they need it, or vice versa, or both, in fact, that you go there with the money and you buy their objects that they have, that once you take the risk and the effort to bring to Venice, no, you can sell it at a higher price, and so on. And so it's quite clear that it's like that. And instead, the debate keeps staying on money is money, and per se is not productive. Therefore, the fact that I gave you money cannot imply that later on you have to give me more, which is a bit like, well, I can lend you a cow and a bull. And because a cow and bull can produce calves, then you can give me back more because they reproduce, right? Then there are more cows in a couple of years. But if you give money with which you buy the cows and the bull, then no. But the whole debate about usury is about this. There are some a little bit more sophisticated, but basically it's, and my only way of rationalizing, okay, I'm not an expert at this, so maybe some people listening or maybe you can correct me. It seemed to have to do with this idea that there is the essence of things, and that the essence of that thing called money is that it's not productive. Eggs are productive, chickens, whatever, but money is money. It cannot be productive, and therefore it cannot justify it. But they all repeat this. So it's very different from the way, the interpretation of price is very different from the one we we think of. And when what I would call the notion we use now come around is in Italy, not by chance, and when trading and banking and so on are already well developed. In the first class, I said, well, if you want to really have a date in which capitalism started, then it started with partita doppia, all right? And these thinkers all come after, much later. Davanzati, if I remember, is about middle of the 16th century, 1550, 1540, 1560. Galliani is 1700, and so on. But it's not by chance that some of the first explicit debate in almost current language of demand, supply, your evaluation, my evaluation, your pleasure, my cost, in the common sense terms that we used in class last week and this week, start with these people at that time. And these are the people, I think it's Galliani, that points out the paradox of water and time. He brutally refuses this idea. He says, look, this thing that objects have a true price and a true value is just completely nonsense. Think of water and diamond. I mean, what does it mean that there is a true price, a true value of water, a true value of diamond? It depends on the circumstances. In town, when everything is fine, you value diamond a lot. If you're starving in the desert, you value diamond nothing, whereas you value water a lot, and vice versa. So there is no intrinsic value. It all depends on the fact that you need it or not, and you have it or you don't, or you have a lot or you have little. And he starts using really these words. These words there, I copied from him. He talks about rarità, scarcity, and utilità. And he has the two sides. It's very interesting. He thinks both of production. And so he says there's got to be a two component to the price cost, the thing we already mentioned. There's the fatica of the producer that has to be compensated. And then there is the rarity, the rarità of the object he has produced, and that will determine how much people are willing to buy it, to pay. And so she will be compensated for her fatica or not, depending on how rare the object she's brought to market is, and vice versa. And then he says that it's purely the utility one gets and how rare the thing is, because one observation all of them make, and other, I mean, quite a few of them make, is, look, I mean, it's amazing. They are much more modern than the classical. It's a bit of a pity that Italy and Spain became so secondary in the circulation of ideas and intellectual world of the later century, 17th, 18th, that all these contributions were lost. Not only these guys, Beccaria as well, because they actually, on the issue of prices, they were definitely analytically a lot clearer, as you will see next week, than the so-called classical, Smith and so on, right? Because they understood that trying to explain the value of something with the fatica alone, that is with the work it contains, with the labor, it's insane, because there are objects that have value and have not been produced. I mean, one can go through very long debates because the classical theory of labor value is still alive. Some people keep pushing, from Smith, even before Smith on, it's there and it goes around, and we'll try to understand why they focus so much in saying, the essence of the value of an object is labor contained and what it means. But the fact that it's obviously false in the sense that there are obvious facts that contradict it, has to do with the fact that there are things that are valuable but have not been produced by labor. In modern day, it's very easy. People pay a fortune for views. Right? Huh? One can say, oh, yes, but whoever bought the building on Miami Beach with that angle, I mind the view. Well, people pay a fortune for a view on Montello in a position where nobody has built anything, just because the hill is there and that particular terrazza is there. Or we can go on with example. It's very simple. It's a lot of things we value. Let me be extreme. Nobody has built beauty, but people have eternally been paying fortunes for beauty. There's no labor behind beauty. There might be genetics, but certainly not labor, right? There's no fatica. Well, in the modern days, there is fatica. You got to go to the gym, but in the old days, there was no the gym. Okay, the people paid for it. So the labor theory value may apply, we'll see, maybe to some object under some circumstances, and we'll try to make clear where it applies. And it's surprisingly easy. In fact, we have already done it in the previous classes. But it certainly is not a good theory of prices because it doesn't capture all the situation in which something is valuable and as a value has not been produced. All right. So that's where I leave you today, in the middle of the 17th century in Italy with these characters. And they're interesting. Go to I think each one of them has some Wikipedia page. Read something. They're interesting. Galliani in particular is very interesting, but also John Law. Davanzati is there just to be a bit, to look like I know more than I do, because he wrote very little. You got to do a bit, I'm sure, right? All right. Thank you. Have a nice weekend. And if there are questions, yes, people are asking yes, probably during the weekend, I hope to have time. I will put the 4 recorded classes up on my website, on my YouTube channels for other people to read. But the student at Foscari can access it, I think, independently, right? I think it's accessible via Moodle, no? Not everyone. All right, I'll put them up in any case. All right, take care, have a nice weekend.